One of the biggest problems that a trader faces is bridging that gap between trade planning and execution. Getting from a strategy looking good on paper to real-world performance is what it's really about. And without question, all the planning in the world is not going to do you any good if you can't execute and reap the benefits of your work. Now, the first idea that many people will consider is that it must be a psychological issue, since trading psychology is often talked about as a cog in the wheel of trading success. But there is a big difference between psychological problems that come out during trading and natural emotional responses caused by certain types of situations. Yes, different individuals may have varying degrees of tolerance, but frustration after a series of losses, for example, is a reasonable emotion to experience. And since wins and losses come in a random distribution, it's not unreasonable to sit through a series of losing trades even if you did everything according to your trading plan. So if it's not about some kind of psychological malfunction that requires rewiring, what is it? Well, one issue to consider is that people are not particularly confident in what they're doing, and this can be rectified with just a little bit of guidance. Understanding what it is that you're trying to achieve and what constitutes reasonable results can go a long way towards settling nerves and allowing a trader to execute how they have planned to do so. Clarity of mind, consistency of approach will help you to start to realize the potential of your trading strategy. So let's say that you have some type of day trading strategy. You've seen the stats from your back testing, and you know that it's performed well in the past. But when you trade it, it seems that you can't even turn a profit. The idea behind a strategy often gets lost when you're executing it. A strategy that's really great in trending markets, for example, it's not going to be too effective when markets are in a trading range. Now, this could seem obvious, but it's the higher time frame to your own that's going to drive your setups. And it's not always easy to extricate yourself from the weeds when you are in the thick of a volatile trading session. And here's where market preparation comes in. As part of your pre-trading prep, taking the time each day to look at a daily chart and assess what the overall market conditions have been and are therefore likely to be can help you to align your strategy with what the market wants to do. You should always try to apply your strategies when it's likely to be at its most effective. A simple example is playing a momentum break from a range after a news release. Price wants to explode to higher prices, and it's going to use the positive release to entice other traders to help it along. And just in case anyone is in any doubt about the importance of backtesting, let's make this clear. If you don't backtest your strategy, you are not going to know how it's performed over time, and you're going to be left with doubts about how effective it is. And if you're left with doubts, you're not going to execute it every time a setup presents itself to you. But there are at least a couple of other really important benefits to testing. And the first is that it helps you to think in trade sets. And this is essential to make sure that you stick to your plan, even if it looks like you might take a loss. A trading edge plays out not over a single trade, but over many trades. And this is why traders who system jump at the first sign of a losing streak oftentimes miss out on the positive trade runs that are just around the corner. And the second benefit is that if you backtest in a particular way, it can help you to iron out any ambiguity in the rules of your trade plan because you see so many trades in such a short space of time. Now, one of the simplest things that you can start to do is to employ a mechanical trading management scheme. If you know where your entries, your targets, your stops are before you take the trade, there can be no mistake where you should execute. All of our systems use a method like that. And the really great thing is that they all dynamically adjust the size of the trade based on the conditions when the setup forms. Now, the trouble with backtesting is that people frequently, they don't know how to do it. They have a set of rules and they assume that unless you're a programming whiz or a math whiz, they can't do it properly. But that's not the case. There are a number of great pieces of testing software out there, but all you really need is a way to record your trades. And it can be done simply in an Excel spreadsheet, or you can use the UTA, the Ultimate Trade Analyzer spreadsheet, and we give away the standard one for free. But the key to this, and going back to the idea of ironing out your trade plan, is manually advancing your charts bar by bar and paper trading the setups as they appear. You're going to be making lots of decisions in a short space of time, and you'll see where the holes in your trade plan are before you attempt to trade it for real. Now, keep in mind that past performance does not always equal future trading results, but oftentimes something that's worked in the past should work into the future. Being frustrated by a series of unfortunate losses is normal, but our subsequent actions do not need to be defined by the emotions. You wouldn't go around hitting people every time someone annoyed you, so you don't need to punch back when the market makes you frustrated either. If you have problems with how you deal with trading frustrations, there are a few ways that you can rebalance things. Mental conditioning and rehearsal. Go through tough trading scenarios many times in order to lessen the emotional response with practice. Limit your self-destruct responses with risk limits. And this means having a daily loss limit at your broker to at least disrupt any costly trading outside of your plan. Be physically and mentally balanced. When you're out of balance, frustration can get to you more quickly and can end up boiling over. Get into the habit of circuit breaking your frustrations. For example, use slow, deep breathing, mantras, getting up from your trading desk and taking a walk. Bringing trade planning and execution together sounds like an easy task, but as anyone who's ever traded for even a short time will recognize this, it's not always easy. Make sure that you know exactly how you will trade before you do. Be confident in your strategy's ability to perform and disassociate yourself from any actions, from any of your frustrations you might feel, and you will be well on the way towards bridging that gap between your trade plans and executing the trading plan that you've devised.